Michael Dell, one of the greatest in the game. He's worth $100 billion. We're going to go through why that happened, looking at Dell stock in the lens of earnings, which come up on May 29th, and take a look at why a low bar in Dell could be an attractive risk reward for earnings. So back in 2013, Dell traded at a really cheap multiple, 4 times EBITDA. Market trades at 8, 9, 10 times EBITDA, right? And why was that? Everyone thought Apple, tablets, and smartphones were about to eat its lunch. So what did Michael Dell do? He and private equity took Dell private for $24 billion. Now let's take a look at what they did after that. So let's say you bought this back on the IPO here in 2018. From 2018 to 2022, Dell stock didn't do much of anything. In fact, the stock market was up and to the right and it was fairly flat. Why? Because the debt holders are the ones making all the money in this case instead of the equity holders. Back to our original slide here, take a look at this 2019 timeframe. They did $9.6 billion in EBITDA. That's good, right? All of it went to debt service. The net income is negative, right? So this is what's happening. But they changed the game, and this is a different company than it was back then. Take a look at what they did here in 2022. What did they do? They spun off VMware, one of the big assets within the company. And by spinning off VMware and sending it off with some of the debt, the leverage ratio, which was over 5, changed significantly. Take $27 billion, subtract $10 billion in cash, compare that to EBITDA. The new leverage ratio, 2.4x. Far better for shareholders, and that is when the stock price actually started to work because you didn't have to pay all your free cash flow into the debt holder. If you've been watching our videos and want to invest alongside us,
click the link in the comments, select your brokerage,
search for ticker RVER wherever you buy stocks.
Thank you, and now back to our video.
So let's take a look at this quarter's numbers. 8% revenue growth is expected this year, but let's look at this quarter. Only 4% on the 29th is expected. Next quarter, only 1% is expected. Love that nice low bar. Add that to the fact that the PE ratio is pretty attractive, that the free cash flow yield is pretty attractive, and what you have is a cheaper stock with a low bar going into the quarter, which may set up a positive risk reward. Lots of like here going into the Dell quarter. You've got that low bar for revenue growth. You've got a cheap valuation going into it, and the capital structure is much different than it was in the past. There is not as many debt holders sitting in front of us, so a lot to like about the quarter upcoming in Dell. Thanks for watching. We always appreciate it. Like, subscribe, all that stuff really helps us, and those emails, keep them coming. We'll keep sending you stocks that you guys love to see. We appreciate it.